Mr. Venkateshwara Ramakrishnan. Mr. Venkateshwara Ramakrishnan is presently Deputy General Manager at Financial Sector and Economic Analysis Cells at Securities and Exchange Board of India. He earned his master's in public administration with specialization in economic policy management from Columbia University in the cities of New York at the Security Air Fellowships. He is since one of the program ambassadors of South Asia. He is also a fellow member of Institute of Cost Accounts of India, a master's in economics and postgraduate diploma holder in securities law. In SEBI, Venkateshwaran sir has also worked in the office of Chairman, Integrated Surveillance Department and Department of Economics and Policy Analysis. He had been a deputation to the Financial Stability and Development Council for 2 years. Venkateshwaran sir has undergone in-person training program at Asia Development Bank, USSEC, IMF Institute of India and Singapore, Chicago University, Booth Schools of Business and World Bank. It is an honor and a privilege for us, sir, to have you with us today. Without any further delay, let's start the section. Over to Venkateshwaran sir, who is waiting to educate us on the topic, marching towards 5 trillion economy, role of financial market. It's over to you, sir. Thank you.
Good afternoon. Is it that my slideshow is visible to you?
Good afternoon, sir.
Yes, sir. Yes, sir.
You can see my slide, not?
Yes, sir.
Yes, sir.
Okay.
Clear.
Okay. So I understand that you are all members of the faculty of the Department of Economics from various universities from across the country. So I just take this opportunity to just talk to you regarding what is the role of financial markets when India is marching towards becoming a $5 trillion economy. So I have been told that there are professors having experience ranging from 5 to 20 years. So how I have structured this presentation is I try to, when I was being introduced, it was mentioned that I myself am a master's in economics. So I have approached this subject from the point of view of a academician also, and from the point of view of a practitioner, especially as a regulatory body official. I'm sure many of you are already active participants in the securities market. Am I right?
Yes, sir. Yes, sir.
So some of you are already investing in either shares or bonds or mutual funds and all. And you must have heard about the SEBI also.
Yes, sir.
So, so now let us go to the structure of this presentation, wherein I will be just covering a literature review. Broadly, I'll be talking about what is the thought among the academicians, especially the researchers, with regard to the role of the financial markets, and within financial markets, the securities market and the banking market. And second, I will take you through the financial sector compared to the service sector and the overall economy in India. And then I will get into more of SEBI related or securities market related topics. So to tell you, I'll be just talking from economy, then coming to financial sector and securities market, which is a sector within the financial sector. So that is how I will be talking to you. And so in the securities market, I will tell you what is the current situation. And also I will tell, when we are marching from the present level to the $5 trillion economy level, what is the role that or increasing role that securities market will be playing. So this is what actually I wish to talk to you. But now that, I have been told that, look, I mean, you are just one day from concluding this session. So let me begin with a question. So when we are talking about our journey towards $5 trillion economy, what is the current size of the economy, Indian economy?
3.05 trillion.
3.05. Yeah. Okay. And what is the, so that is actually the GDP at current prices for 2021-22, right?
Yes, sir.
Yes. Now, the question is, what is the size of the stock market? Any idea? So I will put it like this. Do you think the stock market capitalization or the size of the stock market in India is equal to the GDP or less than or more than the size of the GDP?
Less than, sir.
What about other participants?
Less than, sir.
No, more than could be, sir.
Yeah, if you include FDIs, like you have institutional deposits, maybe it could be more.
No, I'm talking about the total size. Like, see, GDP is a indicator, is a metric for measuring the size of the economy and then comparing it with other countries, also comparing it with India's own performance in the past or over various periods of time.
Size of the market will be more, sir.
More. So now to just, move forward. So how many think that, it is less? How many think that it is more? But nobody has told equal. So I will give the answer. It's so this is like little, both of you were closer because it was less, it was lower, but recently it is higher than the size of the now that is why I will tell you both of you were correct, because that is the underlying theme of today's talk. As economy is developing, the size of the stock market will be growing at a much faster rate. So that suppose something is growing at a above average rate, definitely its share will increase. This is something which as professors, as economists, you all are, agreeing to. Now, this is what I will be telling to you. But we are, talking about this subject of $5 trillion economy. And also we are talking at a time when India is celebrating the 75th year of independence. So to be very frank, what I have done for you people, when University of Madras invited me, Professor Chinnamai was very kind enough to invite me for this particular program. What I have done exclusively for you is that I have mapped the growth of the financial services right from the time the GDP data has been available, that is 1950-51 up to the current year. So, but before getting into that data, let us look at what is it that the global scenario is. What are the academic studies everywhere that is telling about the role of a securities market in the case of economic development. Now, I am showing you the next one, which is basically I have restricted myself to 4 studies. Many of you might have already read about the role of the securities market in economic development or role of bank in economic development. All these things you must have read. But I also wanted to tell you that, it's not that these are just 4 papers. there was a reason why I have selected these 4 papers. First is that, I have looked at it from very authentic sources. I mean, reputed journals. Second is that I try to take, what is the global picture, but India is an emerging market economy. Second, we are within the Asia Pacific region. So I have also tried to just bring in some flavor of emerging market economy in the case of regional region where India is located, Asia Pacific region, and the global picture also. So the papers that I will be touching upon, because that will tell you, and then we will go and look at what is it that the 75-year data or data from 1950-51, what is it that it is telling us. So I have selected 4 papers. The 4 papers are, one is a World Bank working paper, policy research working paper by Demir Kunsch, Fayan, and Levin. The evolving importance of banks and securities markets. And this is a 2011 paper. Then Popov has brought out evidence of finance and economic growth. And let me tell you, this paper is something, I mean, I would strongly recommend all of you to read all these 4 papers. Now, because they are all small versions, I have it with me here. I will show it to you as and when I go to them. But what I wanted to tell you is, if you have an interest in knowing more, these people have done a lot of literature survey, which covers even the earlier studies in this area. So I have also chosen as recent papers as possible, because that will also take into account all the work that had been done before that. And also in the current context, when I am saying the Asian financial crisis of 1997, the global financial crisis of 2007-8, all these things and their impact also will be covered. That's why I have restricted to these papers which are recent. So yeah, why I went to this paper is, suppose you people don't have time to read all 4, read Popov, because that is a elaborate summary of the academic research that has happened into this subject. So I will tell you, you prioritize that one if you are short of time. Second is, the third one is Estrada, Park, and Ramayandi, and that's an Asian Development Bank working paper. So they look into the Asia Pacific region. And the title of their 2010 paper is Financial Development and Economic Growth in Developing Asia. And last one is the role of stock exchanges in fostering economic growth and sustainable development, which is a 2017 paper. But the emphasis that I am giving into the paper is because of 2 things, because it was a joint effort by the United Nations Conference on Trade and Development and the World Federation of Exchanges, which is an umbrella body or association of the stock exchanges across the globe, whether it is from the Americas, Europe, Africas, Asia, everybody, leading stock exchanges, almost every stock exchange is a member of this body, and they have done this research based on inputs from across the stock exchanges. So these are the 4 papers. Now let us go to all these. So let's go to each paper one by one. So the first paper is by Kunt, Fayan, and Levin. So the study is very interesting because World Bank only has done it. And allow me to show you if you want to see the hard copy of it. Yeah, this is the one. See, this is like, it's a very small working paper. It's like, so this is very interesting finding. What it says is that as economies grow, their conclusion, I am just reading out for your benefit. But if you are interested, you can look at, which are the economies that took part in that study also. Now, if you allow me, I think let me go to this screen sharing. Okay, I think I will come next. Okay, so what it says is that as economies grow, both the banking system and financial markets become more developed. So development and development of the financial market, economic development and development of the financial market, they are complementary, but the sensitivity of economic output to bank development tends to fall, while the sensitivity of economic output to securities market development tend to increase. So this paper says that as the development goes along, the sensitivity of the stock market to development process is what increases, whereas banks' response or sensitivity to the development actually gets reduced. The services provided by financial market become comparatively more important as countries grow. So if you have to put it in another way, I will say that rather than bank, financial markets tend to perform greater role as an economy grows. I mean, as its GDP is increasing over a period of time. The financial institutions provide different financial services from those provided by financial markets. So it is very clear to you that the financial institutions, what they are telling here, they provide financial services. So what they are referring is the banking sector. Very simply, it is the acceptance of deposits and lending to the borrowers. So lending to the borrowers or bank credit, that is what is one aspect, that is what is referred by the financial institutions provide different services, but main of it is the lending, bank credit. And that is different from that provided by financial markets, which is the raising of the capital by way of issue of equity securities or debt securities, or what you call as bonds, or even hybrids, which are a mixture of equity and debt, which has a flavor of both debt and equity into it. As economies grow, they require different mixtures of these financial services to operate efficiently, so that the optimal mixture of financial institutions and markets evolves with an increasing relative role for markets. It's very evident. I don't need to repeat it, because whatever we have said in the previous paras, this is emphasizing that one. And policies and institutions that impede an economy from optimally adapting its financial structure will hinder economic activity. So this says that if authorities want to really, give a big boost, big catalyst to the economic growth, what they have to do is they have to adopt policies that are more market friendly. So this paper, I am summarizing it for you. This finds that in the process of economic development, financial markets or securities market will get an edge over banks. I think I am clear to all of you. If you will allow me, we can go to the other studies also now. Shall we move? Yeah.
Yes, sir. Yes. Yeah.
So, yeah, I mean, any questions?
No,
Okay.
sir, no, sir. Just
Okay.
go
No,
ahead.
no, no, sir.
So next paper, this is what I told you. This has so many references. It has done, I mean, rather than giving its own findings, it has actually listed many of the academic literature which has happened before it. So that is why this particular paper I have devoted 2 slides. First one, what it says is that, so it has also, as I told you earlier, research is of older days also, but because of certain events, like when the data changes, the conclusion as well as the recommendation will change. So because of that, some of these events, which you economists will call as black swans, once in 1,000 years, when it has happened, definitely it will affect the data, and accordingly, your conclusion will change. So here, there is a clear, identification of that phenomenon. So let's look at that. Early research concluded that conditional on the quality of a country's legal, regulatory, and general institutional systems. There was no general rule that bank-based or market-based financial systems were better at fostering growth. So old research, or what I am saying is, what was prior to this global financial crisis or the Asian financial crisis, there was no concrete study or finding to tell that over a period of time or as development progresses, one part of the financial market, say financial markets, within financial markets, say securities market will get an edge over the other parts, which are the banks or be it any other sector. So early research did not have that much of concrete proof to tell that one. Most recent research, learning from the experience with the most recent financial crisis, provided somewhat of a reassessment. So that particular view got changed after the Asian financial crisis and the global financial crisis. It is true today also that both markets and banks exert a positive effect on economic growth. So there is no contesting of that particular fact. Both of them play a role in economic development. But there is now some proof to say that the earlier complementary role, or both are of equal importance, that has got little affected. That viewpoint has got little affected. So what it says is that only stock market development has a positive effect, and that banking development has an unfavorable, if not negative, effect on growth. The more limited impact of banking on growth as income rises appears to be more general. So it is not just for a few set of economies. It is not just for, say, developed economies, or it's not just for emerging market economies or developing economies. It is across the board. Every economy experienced a scenario where securities market had larger impact and bank had limited impact. While both bank-based and market-based financial systems support economic growth on average, their contribution varies with the extent of financial and economic development. While market-based systems outperform bank-based systems among countries with developed financial sectors, bank-based systems are far better among countries with underdeveloped financial sectors. So what it says, the last portion, the last sentence that I read out, it says is that if the institutions are well developed in a country, so it could be, you say, like there is rule of law, there is a established, with the judiciary, with the constitutional backing. So corporate governance practices, statutory autonomous regulators. So when institutions are well developed, in those economies, market-based systems, they outperform bank-based systems. So in those economies where these institutions are not so developed, so it is very clear that those are what we can call as least developed economies or developing economies. The nomenclature can be anything, but if institutions are not developed, then it is better to have bank-based financing of the economic growth, because that will be comparably more efficient or better. So this is what Popo has said, and I have one more slide to conclude the findings of this particular paper. So what it says is that as countries develop economically, the association between an increase in economic output and an increase in bank development becomes smaller, and the association between an increase in economic output and an increase in securities market development becomes larger. So this also is finding that as growth progresses, as countries or economies tend to have larger and larger output, securities market tend to have a greater role than banks in those economies have. There are evidences of diminishing effects of banking at higher levels of development and increasing effects of securities market. This is again reiterating what the earlier paragraph said. The capital markets also induce greater productivity gains, innovation, and technological change than banking market. So this is another new perspective. That is, it's not that, it's just the same set of institutions or infrastructure. There is a change there also. So innovation happens more with market-based institution, market-based growth path. Not only that innovation, even productivity gains are also there, and technology changes also. So the role of technology also is now embedded into this regression. Industries that are more high-tech intensive exhibit a disproportionately higher innovation level in countries with better developed equity markets. That is what it is. You have to take note of that last part of that last sentence. Better developed equity market. So if the securities markets are developed, the chance is that not only that there will be higher levels of innovation, the industries will be more high-tech oriented. So this is also, as I told you, taking into account the recent developments. And the last point that Popo is saying is that as per capita income rises, countries' financial structure tend to move towards non-bank financing. Market-based intermediation has thus grown faster than bank-based one, notably in advanced countries, also due to advances in technology, the greater availability and use of hard information, and more internationalized financial systems. So that is the sum and substance of what Popo has brought out in his paper. And now we go to the Estrada G, Part D and Ramayan DA. So that paper also, that's what actually, that's what I told you. So this paper is the ADB working paper. This is also very small, nowadays working papers are also very small. They are not so bulky a document. But why I'm telling you this particular paper is because it has the Asia connection. So we are also within Asia. So the findings will be more relevant to India. So now let's look at what is it that the paper is talking. So it says that there is a strong evidence of a positive influence of financial development on economic growth. Overall, financial development as well as bank development and stock market development all exert a significant positive effect on real per capita GDP growth. So here it is like, everything is complementary. Financial development, bank development, stock market development, everything exert a positive impact on the real per capita GDP growth. So here, that's what actually, so this paper, it says it is all are equal. Total liquid liabilities of the financial system have a bigger impact on developing Asia's growth than in other parts of the world. So what this says is that we are more driven, our growth is more driven by our own financial resources. So that is what actually, so our dependence on outside liabilities is comparatively less. We are driven by our own resources from within our own frontiers, each and every economy within the Asia Pacific region. Overall financial development matters much more for growth than the structure of the financial system. That is relative weight of banks versus equity and bond market. Now, this particular paper, its findings are totally different from the other two papers that we have looked into. Here it says, that's why I told you, this is from the Asia Pacific region. It says that it's the level of development of the overall financial sector that matters most in the case of Asia Pacific, rather than, which sector is more developed within the financial markets. So whether it is bank that is more developed or securities market that is more developed, or let's look at the other two sectors also, insurance market, pension market, that doesn't at all matter much. So the data from the countries that are in the Asia Pacific region, it specifically says, and this paper also is hardly, 10-year-old. It's 2010 page paper. So what it says that there seems to have been a sharp drop-off in the effect of finance on growth since the Asian financial crisis. Let's read the rest of the paragraph because that is explaining this particular thing. The apparent structural change reflects a reversion of over-lending and over-investment in the pre-crisis period to more sustainable levels of lending and investment. A financial system has to evolve along with a country's overall development level in order to contribute to growth on a sustained basis. To some extent, the decline in the contribution of financial development since the Asian crisis could reflect the fact that the evolution is still incomplete. Now I will stop this for a moment. Can anybody tell what this is referring to?
So it means like, see, the earlier two literature said, like, if as a country grows, in terms of growth and development, the role played by the financial, institution will improve. But this says if there is a financial development, it will back up the economic growth and development. So I think basically your investments, capital formation would be more. And I also feel like in India, like people, we prefer, particularly South India, we like to invest in gold and land. So like people don't think about investing in, like the share market to be one of the options. So it says like, if you invest in the financial market, it will foster growth and development. It could be a way for the $1 trillion economy. That's what you're trying to say.
Yeah. Any other viewpoint? Anybody else would like to comment on this?
Sir, good afternoon, sir.
Good.
Ma'am, sir, I am Madhumati from Parashakti College, Kuttalam. Sir, I have a doubt. Always the share market, it is considered as a risk capital. In that condition, what is the status of the middle class people regarding the share market, sir? I want to know from you because you are in share market field. The condition of middle class people, whether they are interested to invest in the share market or not.
Yeah, thank you for that question. I will be coming to some data, actual figures, latest figures also, which will answer your query. But to complete this entire presentation within the time that we have, the questions that are not connected to the particular slide can be kept towards the end. We will have a separate question answer session, and not only the areas that we are covering now, anything that you have to get clarified from me, I'm free and I can open the floor for questions at that point of time. So my particular point at this point of time in our presentation is this particular third point. What is it that it is saying? Because that has a very significant, lesson with regard to the role of financial market. If anybody else, anybody else have a comment?
Sir,
Yeah.
Sir, to my understanding.
Hello.
Yes, sir. I'm Dr. Mariappan from Loyola College, sir.
Yeah.
Even the statement what you have highlighted, third paragraph, there seems to have been a sharp drop of the effect of finance and growth since the Asian financial crisis. The reasons what here it is quoted in this particular paper is also a more valuable one, sir, due to overlending, overinvestment, and pre-crisis period to more sustainable level of lending and investment. That revision process that reflects this overall change. even I'm also able to understand and as well as accept this particular statement too.
Anybody else? One more person or one or two person? I can, because this is very important from the subject that we are talking.
So according to my understanding, I think when a financial institution is giving lending for investment, that investment should create some physical asset in the country. Otherwise, the what a lending process will not be in a very progressive manner, sir.
Yeah.
It should have some physical asset. It should have created some asset.
Yeah. So you are closer to that particular point that I want to emphasize, but I will tell you in the context or, in the aftermath of whatever we read about, be it the Asian financial crisis or be it the global financial crisis. As has been rightly emphasized, over lending and over investment. So these are two things. Lending is by the banks, investment is through the securities market. Now, I will just tell, this entire thing, what is running into 7 lines can be summarized. You people have, I'm telling you, not once, many times you have heard the sentence that I'm going to tell you. That will summarize this, this one sentence, hardly a line, will summarize what is written there in 7 lines. Tail cannot wag the dog. Finance is the tail, economy is the dog. So whatever, in the case of global financial crisis, it was securitization. In the case of Asian financial crisis, it was financing which had come to those Southeast Asian economies in search for higher yield. So it happened through investment or through finance. But what happened was that at that point of time, the financial markets, they were growing at a higher pace, which did not match the real sector requirements. That's why I'm telling you, you people will recollect now, in the aftermath of the crisis, this particular thing, the tail cannot wag the dog. Finance has to be serving the requirements of the economy in which it is there. So you must have read securitization, and that was like, on set of securities, securitized products were created, but then there was another level of securitization based on securitized securities itself. So that was the level of explosion that was happening. So that was if you read now this particular thing, you will understand financial development is very much required, but it cannot be, at the expense, or, it cannot be the primary priority. Primary priority is growth. And in the current scenario, let me just make it clear, it has to be sustainable and equitable development. So it's like we have to take care of the earth also, environmental degradation. So now that has become sustainable development, and similarly equitable development. So you are more worried about per capita income rather than, GDP alone going up. So let's now just move on to the next point. The global financial crisis. Of course, this also is, earlier one was just exclusively on the Asian financial crisis. The last point is about the global financial crisis. It says that the global financial crisis underlined the devastating impact that financial instability can wreak on the real economy, even in large advanced economies such as the EU and the US. This should put to rest any doubts about the importance of financial stability for growth. Safeguarding financial stability is paramount for sustaining medium and long-term growth. So this is what actually, once again, saying that we need to have growth, we need to have growth of the financial sector also, but financial sector need to be stable. So stability, financial sector stability also has become an important goal or objective. So nowadays, because of whatever is happening in the financial markets now, if you have read the last few statements of monetary policy statements of the Reserve Bank of India, when it is addressing the inflation conundrum, RBI is very categorically saying that controlling inflation, I'm not exactly, quoting, but I can recollect and tell you, controlling inflation is what can contribute towards a stable and growth-oriented Indian economy. I mean, this is what actually, a take home rather than, copying and or reading out. This is what it is. So financial stability. So this is what actually, so whether it is the global financial crisis or whether it is the Asian financial crisis, now financial stability has become an important objective for all the authorities to pursue whenever they are thinking about adopting a policy. Now, so at least this ADB working paper is different from the other two papers that we discussed, where it says that, look, I mean, Asia, and another thing I am highlighting, it is about developing economies only. So they have mentioned that one. So it is like they are saying that both sectors of the financial markets, banks as well as securities market, they have an equal role. You cannot say that, look, I mean, in Asia, I mean, so evidence from Asia says that both of them are equally important for the development process. Now, the last paper that I have before you, that is a joint paper. Let me see, I think, yeah, I think one more slide is there. Sorry, I mean, so Estrada and et al., that paper says that financial development has a positive, significant effect on growth, suggesting that financial development will be a key ingredient of the region's medium and long-run growth. So it says that, look, I mean, we need a solid, vibrant financial sector, then only Asia Pacific economies can have medium and long-run growth. Second, it says that expanding and improving access to financial services for both households and producers will remain a key policy priority for financial development. This again, if I can ask you, what would be one term which will just, summarize? Two words are there, which is a buzzing word today, which will summarize these 3 lines. Expanding and improving access to financial services for both householders and producers. All people are, after this, and everybody.
Financial inclusion.
Yes, that's correct. So financial inclusion should be a priority. And so then we can move to the other one. Speeding up the integration of developing Asia's financial markets, especially bond markets, can yield substantial gains for the region's financial development. Now, this is one area, if any of you are interested in, pursuing it, you must be knowing that, look, I mean, like I told you also, that there are so many studies showing the relationship between financial development and economic development. But one missing link is the role of financial development in bringing out trade. Some of these papers itself, I mean, I will strongly suggest you, if you have time, please read these 4 papers if you are interested in the subject. So one of the missing link is financial development and growth of international trade. Another one is that, look, I mean, if you look at it from the point of view of our country, look, I mean, like we have just recently celebrated that India has crossed the $400 billion mark in exports during 2021-22. So even though, we have a booming international trade, which means our integration by trade channel with the rest of the world, not only in India, but even in other economies within the Asia Pacific region, integration of financial markets is missing. And one particular area is the bond market. So this is one policy recommendation that they are saying, that if it happens, economic development in the region will speed up. Strengthening regional financial integration is an important means of furthering overall financial openness, which is beneficial. Financial development requires very different institutional and policy reforms in different developing Asian countries, since they are at very different levels of economic, institutional, and financial development. So this is another one. If you ask me, there is a one-liner which you people have come across many times. It says that no one size fits all. That is what our region, the various economies are at, various countries are at various stages of development. So there cannot be a single prescription as regards the countries in the Asia Pacific region is concerned. So as regards economic growth, as regards fostering economic development, you cannot say that, look, I mean, okay, you have to rely exclusively on banks, or you have to rely exclusively on securities market, or you have to give this much percentage to banks and this much percentage to securities market, nothing. It is country specific factors that you should take into account and accordingly come out with a prescription for boosting the economic growth and to make that economic growth really sustainable and equitable. So this is concluding the, this slide concludes the findings of Estrada and et al. And now I come to this World Federation of Exchanges study, and that is also a joint paper between UNCTAD. So what it says is that there are two main mechanisms through which stock exchanges can contribute to development. Now, let me tell you, this paper, I will suggest you should look at it from what the other two papers, first paper and second paper, said that, look, I mean, there is a greater role of securities market. Now, if you understand that there is a greater role for securities market, then what are the things that you should be looking at when you are putting that extra emphasis on the securities market? So this paper gives some hints as regards that. And what it says is that first is mobilization of resources for sustainable economic growth and development. Well-functioning exchanges facilitate the mobilization of domestic resources and foreign portfolio flows. Here, I will like to now stop and ask you another question. So when we are talking all these things, look, I mean, role of financial market and economic development, what is that fundamental equation that we are all examining from various angles here? What is that fundamental equation of the economy?
Is it the savings and investments? Huh?
Saving investment is there, but that's just a small portion. What is the broader one? How do you arrive at the GDP?
It's a four-sector model: C plus, I plus, G plus.
Yeah. Actually, you know, I will give opportunity to everybody to speak. So if somebody else is talking, please.
Yeah.
I think two people have spoken. I could not hear. Please.
So this comes from the four-sector model of Keynesian theory, that consumption, investment, government expenditure plus international sector.
That is net export.
Net export, import.
So what was somebody else was saying that?
The same answer I said. Y is equal to C plus I plus G plus X minus M.
So now in that one, what is it that we are talking in this particular session now? Investment. Because C, that is basically a demand side. Aggregate demand. Then investment is there, but how to finance that investment is what one aspect. Second is that government sector, of course, government is also a borrower. So there is supply of securities from the government. Households, they are the net providers of capital because they consume less. I mean, out of their total income, they consume something, but they invest, they provide the savings. Corporates, on the other hand, they are the people who require funds for investment. So what you are saying, I mean, everything has been summed up correctly. So, and net exports, what you said, in the balance of payments, there is one thing. There are actually rather two things, but one thing from the securities market point of view, which is important. What is that one? You people have read about it day in, day out, especially these days. You cannot read a paper without reading about that particular thing. Especially with what is happening today. When I will give one more clue. When rupee is galloping towards 80 per dollar, what is one factor that is often cited as causing that fall, which is related to balance of payments?
Our exports are not.
No.
No.
Exports bring us.
It's about oil imports.
So it is other one. If you had told oil prices or gold prices, I can understand, because that actually demand the dollar for the imports. So that is not the one. So if you are telling imports, yes, I will say that is often cited because of the geopolitical tensions, because of crude oil quoting at above $100 per barrel, $100 per barrel. Yes, that is right.
Yeah, people have withdrawn funds from our country. Foreign investments, they have withdrawn.
That is what it is. Foreign portfolio investors, FIIs. FIIs are actually, to give the picture now, I will give details later. Everything is coming. So what I wanted to tell you is, at least what foreign portfolio flows, it's already there. So in this calendar year, that is starting from 1st January 2022 till date, more than $30 billion is what the FPIs have taken out. Of course, one factor is Federal Reserve is thinking about, of course, it is not thinking about, they have actually effected 3 instances of interest rate hikes, policy rate hikes in the US, European Central Bank, Bank of England. So that actually the withdrawal of the unconventional monetary policy, and as a result of which foreign investors are withdrawing from India. So $30 billion is what has been withdrawn till now in the calendar year 2022. So that is what actually well-functioning exchanges facilitate the mobilization of domestic resources and foreign portfolio flows. So whether it is households who want to invest their savings, or whether foreign portfolio investors, whether they have to come and invest, stock exchanges in the country should be well-functioning ones. That's
So
it.
whether in India we are not having this full capital account convertibility, no?
That you can tell whether we have for full capital account convertibility.
No, so I think it is partial only, sir.
That is what.
Whole
So,
on a sudden we cannot take out the money from
that
India.
is what. So we are having current account full convertibility is there,
Yes.
but the capital account we don't have full convertibility. Like I and you, there is a limit is there, annual limit is there, $250,000 that we can fully take out. So capital account convertibility, we are not having full capital account convertibility. Exchanges around the world are increasingly focused on improving SME access to finance, as evidenced by the dramatic growth in the number of dedicated SME markets. So this is, like large corporates, they have access to the bank finance, and they will get those bank finance at attractive rates also, because they are so large ones. So the chance of a big corporate approaching the bank, the rate or the terms of the bank extending the loan to them will be much better than in the case of small borrowers. So here what says is that in the case of stock markets, there is an increasing focus towards small and medium enterprises, and you may have also come to know that the stock exchanges in India also have separate segments. SME segments are there, which facilitate fundraising by them, and to facilitate that one, disclosure requirements for them are all less. So what I am saying is, globally there is now a focus of SMEs getting their required finance through the stock exchanges. Then another one point is, a number of exchanges offer sustainability themed products and services, from ESG themed indices and funds to green bonds. These assist in promoting companies that better manage ESG issues and mobilizing funds towards addressing sustainability challenges. Now, this one particular point alone, it will be taking at least, 1 fortnight, 14 days of sessions you people can have, because of the focus right now on the climate change and sustainability financing. So what I am summarizing here is that, okay, let me tell you one thing. What is it that distinguishes from your point of view? Many of you told you have been investing in securities market. What is it that, you people can tell, the most important thing that you can tell with regard to, your investment in the securities market, whether it is mutual fund units, whether it is equity securities, and from the same investment that you may have done in the case of a bank. Say, for example, you opened a fixed deposit or, anything else. What is it that is different? It's little technical, let me tell you. I mean, you may not be able to answer it quickly. I will tell you, see, your investment in, say, for instance, I mean, I'm just taking an example. I mean, see, before that, I should tell you whatever I'm telling you.
Is it the risk factor?
Huh? Come again?
Is it the risk factor that differs from?
Risk factor is there, but see, I will tell you, let me modify. That was not the perspective, but since you raised that issue, let me tell you. In the case of, say, a deposit in a bank also, it is only up to 5 lakh. Anything above that, you are losing. Suppose the bank is facing a run. So you cannot say risk factor is there. I mean, so what I wanted to tell you is that risk is, no, it's not that that risk is not missing there. Risk is there. Only up to 5 lakh. No. So what I wanted to tell you is, very simply, I will put it like this. Be it your invest. See, so I mean, I wanted to actually tell you this in the beginning itself. All the things that I'm telling you, they are all my personal opinions. They don't, it's like a standard regulatory disclosure that we have to give in every forum. So they don't reflect the views of SEBI. So these are all my personal opinion only. So this is something I should have told at the beginning of the presentation itself. So now, why I remembered at this point of time is that, look, I mean, I'm giving you one latest example, and which you will be, everybody will be able to connect yourself with that. Let's take the case of LIC. Now you invested in, suppose, let's imagine that you invested in the IPO of LIC. But everything about that is there in the public domain. Disclosures are there. You people have read advertisements. You people have seen how you have, applied for the shares in the IPO, everything. So it's a disclosure. Whereas compare that with, you opening a fixed deposit with the State Bank of India or ICICI Bank or HDFC Bank. That is only between you and the bank. There is nothing, I mean, at least that investment, that is just between you people and everything. Okay, what is the interest rate and what is that the period of deposit? All those things are there in the public domain. But so many people getting their FDs opened, that much granular details are not there in the public domain. Whereas in the case of LIC, if you look into the NSE or BSE today, you can find out how many investors are there who own the shares and what is the value of their investments, or you can multiply by the number of shares into. So how many investors are there, number of shares those investors are owning, and suppose you take the pain of multiplying the current market price with the number of shares they own, so you can find out the value of, say, for instance, the shares that is owned by Government of India, value of shares owned by other institutions like insurance company, other insurance companies or banks, foreign portfolio investors, mutual funds. Similarly, what is the value of investments that are being held by households? So it is possible. So that is the granular level of, so it is based on a disclosure based regime. And why I just remembered this particular, so similarly, like I will tell you another point, had you bought a insurance policy from LIC, so that is only between you and the insurance company. None of those things are, periodically disclosed by the company at the stock exchange or with anybody. macro picture, you will know, yes, LIC today has underwritten this many policies, this much premium, first year premium it has received, all those type of macro picture you will get. So this is what actually, so what I want to tell you is, when the current focus, the present day focus is on sustainable finance, and that is because of the climate change and the impact that climate change is having on everybody today, every economy today. So there is an emphasis on ESG. What is ESG? Environmental, sustainability, and governance. So it has to take care of the environment. You cannot degrade the environment and produce something larger quantity of output also. If it is at the cost of environmental degradation, no, nobody wants that today. Sustainability. So you have to ensure that it is in a sustainable manner that you are producing, and society also you have to take care of. So that means a company, it's not operating in a vacuum, it is operating in a society, and it has to take care of other stakeholders in that ecosystem. That is why today you must, so what S is standing for is what actually is conveyed by what you people have read about or known as corporate social responsibility. So you have to earmark towards corporate social responsibility also. And G is governance. So a company, even say today LIC you take, still it is 96.5% owned by the government of India. Only 3.5% only was sold in the IPO. Still, those 3.5%, those shareholders matter. That is what the governance is all about. Governance is talking about being concerned about all the stakeholders and not a few shareholders or few majority shareholders. So that is what. So it's not the shareholders, it's the government, it is the regulatory bodies, it is the customers, it is the suppliers. Everybody has to, I mean, you know, the society in which it is operating. So I just wanted to, you know, spend some time on this topic because, you know, it's such a large ocean today, but that particular theme can get a big push through the securities market because they are all disclosures, and those disclosures can be monitored, and the relevance as well as the reliability of that one can be assessed based on ratings. Rating agencies can have sustainability ratings also. So those type of products, like it's already showing good growth in European markets. Europe is far ahead of other countries, whether it is America or the Asia Pacific as regards ESG is concerned. Of course, we also have given certain commitments, and in the Glasgow conference, COP26, you people must have already read, we have given our national commitments, which is known as the Panchamrit Doctrine by Prime Minister Narendra Modi. So every country has given their commitments. So it all is aimed towards net zero emissions and how to control the greenhouse gases so that everybody's net zero emissions, everybody will be reaching the net zero emission goals. So that is what this is all saying, that, you know, in this particular change in our priorities, stock exchanges have a greater role to play. And the other one is that promoting good governance in business practices. Now, what it says is that, again, you know, taking from the G of this ESG, many exchanges are promoting greater ESG disclosure among listed companies via voluntary guidance, listing rules, and training activities. So this again is a fallout of the earlier point. So I am not again emphasizing that one, but, you know, one thing what I can share with you is this particular thing, that is sustainable finance and also ESG. This will have lot of potential for research in the days and years to come. SME development is about more than access to finance. Some stock exchanges have introduced programs to help SMEs to develop their management capacity, strengthen their governance structures, and innovate and grow. So what this says is that in addition to providing a platform for small and medium enterprises to come and raise the capital, the stock exchanges can play a role of hand-holding them at the initial level of their growth. So some funds can be set up which can be used for all the SMEs that approach them. Some funds can, those funds can also be used for helping them even when they get listed in the initial years. So this is what it is. In India also, as you people are aware, there is a lot of emphasis on development of the MSME sector. The main reason is that they provide employment to a larger number of people than even the large corporates. So that is number one. Employment is the basic thing, and if employment is there, definitely income is there. If income is there, demand will be there, and also saving will be there. Another thing is that these small and medium enterprises that we are talking about, they are actually supplying the ancillary units of the medium enterprise, large companies. Say, for instance, everybody must be knowing, all of us buy car, but many of the fittings inside the car, take out the engine, take out the steel portions, but rest all, dashboard fittings, everything, they are all made by small and medium enterprises. So they are all ancillary units as regards large manufacturers are concerned. So that is also another thing. So if you are not able to take care of these SMEs, even the large corporates also will get affected, because then they will have to think about producing them, which may not bring out the efficient scales, the economies of scale that these people are able to bring out. Another example that I can give is, like, we all get branded shoes, but many of them are manufactured at small and medium enterprises, and these people take it and brand them subject to the products meeting the quality standards. So I think I have given you a very good introduction to the literature that is there in economics and finance as regards economic development, financial development, and the relationship between the two, and the role of various sectors in the financial market in the economic development process. So this is actually the first portion of my presentation. I understand that we have a break at 3:30, so I will like to keep it little flexible. See, I will now show the data on. Now, why I gave you this background is, now you should look at the data and understand what is it that our economic development experience is, and look at that experience from the point of view of development of the banking sector, development of the securities market. So first set of GDP data, which is basically sourced from Ministry of Statistics and Program Implementation, we will completely go through, and then we will have the break. Suppose it exceeds 3:30 also, please bear with me, and you will have 15 minutes of break, and then we can reassemble and go to the securities market related portion of my presentation, because this slides that I'm showing you, it is very much related to the theory that I have already taken up with you, and you people can tell, you can connect with what is it that we discussed about those 4 papers from those slides. So first slide is about growth rate of GDP GVA, and that is gross value added, and financial services subsector. Now, as you can see, this is growth rate. Growth rate means you need to have one base year and then only you can compute the growth rate of the next year. So suppose there are 100 observations, you can have only how many growth rates? Suppose there are 100 observations are there.
99, sir.
99. So that is why, please look at it. We have data from 1950-51, but growth rate is only from 1951-52 because 1950-51, based on that one, I compute 51-52. So that is what actually this is. And if you look at it, see, I have put some standard, I have standardized this one. Orange one is the growth in gross value added at basic prices of the financial services subsector. Now, agriculture, mining, so that makes up the primary sector. Then we have construction, we have electricity, we have manufacturing, so there is a secondary sector. And then we have the tertiary sector or the services sector. So that is what I have. First picture I am giving you, the financial services subsector. So that why I'm calling it as a subsector is because it is within the service sector. This data about financial services, it comes within the service sector, and service sector is a part of the overall GDP and the GVA. Now, all these years, if you look at the growth rate of the GDP and growth rate of the gross value added, so one thing is that GVA growth rate and GDP growth rate are almost the same. But the point that I want to emphasize in this particular slide is especially when we are looking at a table of, at a data from, and this is, let me tell you, this is based on the current series of national income. So when you look at that, you can understand that the growth rate of the financial services subsector has been better, larger, greater than the growth rate of the GDP or the GVA. Correct? So similarly, if you look at this one, yes, there were a few years. Look at this one. This is 1973-74, then 74-75 here, 2000, 2001 here, 2003-4 here. So there are a few occasions where, but they are very few. I am telling you, most, if you look at it, if you put a trend line, the trend line for the growth rate of the financial services subsector is always above the trend line for the growth rate of GDP and growth rate of the GVA. And another thing that I wanted to emphasize here is, if you look at this particular thing, when COVID hit, this growth rate is not only that, look, I mean, it is not only that it is above the growth rate of the GVA or the GDP, it's even positive. But I don't need to give the explanation for that one because they were declared as essential services. Banks were working, not even a single day banks were closed because of the national lockdown, the first national lockdown of March 2020 to May 2020. They were working, stock exchanges were working, so they were essential services. So this is first point that I am telling. So let's go to the next slide. Now here what I am doing is, again, same growth rate of the financial services subsector, which is what you are seeing in this orange line, which is actually, same thing what you have seen earlier. See, it's almost, there is no change there. But here I am just comparing it with the services sector. Now, if you see, even within services sector, this particular growth rate is superior in almost every year, except, a few, okay, of course, here there are larger number of occasions where, yeah, yes, almost the same only. So whether it is the overall GDP or overall GVA or the services sector, financial services sector has grown in a superior manner. Now, I have a question. So what conclusion you will have? I mean, I am sorry, this is not in slideshow. This has the other slide. So you can make, if you people go, look to the left, you can make out. But I have a question. So what would be your conclusion from this? Which will be my next slide? I mean, my question, you just understand from the point of view of the 4 papers that we have just discussed. Economic development.
It basically it is going to tell us that finance sector is not the sole everything in the economy, and it just
come again.
Financial sector is not the only thing that is we should look at the economy. Economy more
yeah, that is there. So next, anybody else?
Is showing that every growth of financial sector is overpassing the growth of real economy. But however, the economy is not being in fact pulled to the the partnerships between finance and is depends upon what kind of what level of the growth is in terms of the economy, and also what level of growth of banking sector in that particular economy also matters. Because what I understood from the literature about financial growth is that there is a threshold level for each and every sector, particularly this banking sector and financial sector. And beyond reaching this particular sector, that threshold level only, financial sector is going to help the real economy towards the high growth of the economy.
Yeah. So yes, its point is well taken. Next, anybody else?
Sir, if you go to the previous slide, no, sir, I'm noticing a pattern between the brown line and the green and yellow line. It looks like a mirror image, but a smaller version.
Which one?
The 10th slide. Yeah, this one. See, you see the brown line and the green and blue lines. No, blue and green lines are already colliding together. But the pattern of the financial sector and the others, I know there is some pattern which is following, at least beyond 1974 or something. I can see, like, the growth pattern is, so some magic is happening through the financial sector. That's what I can see.
Anybody else? Okay, so both the points, what you said is, both the viewpoints are very relevant, but first I will address that one. Yes, so first and foremost, here we are looking at the growth rate only. But even within that growth rate, the first point that has been made is that, look, I mean, financial sector is there, but look, there are other real sector that we have to really, by that real sector, it could be the agriculture, it could be the manufacturing or the secondary sector, and it could be other services, like for instance, biotechnology, information technology, all those, hospitality, restaurants, hotels, all those things also need finance. So we have to have a holistic approach. That was the first point that has been made. And there are threshold levels, of course, that is what the factor productivity tells, that look, I mean, every time you cannot maintain the same level, each and every factor of production, if you consider, that is true. But then there may be some technological innovation happening, or there may be, like those type of things will be there. So, but then there is a shift. Because of that shift, of course, the there is a split in the data also. So, but I agree with your point. Yes, thresholds are there, and those thresholds also should be taken into account, and accordingly you need to just assess the role of each and every sector within the each and every unit, whether it is banking or securities market within the financial sector. So I think I have summarized the first person's, very interesting observation. Second one, what you said, yes, it's magic in the sense, I agree. I will tell you, see, I put it differently, but you put it in an interesting manner. I told, if you look at it, see, when compared to GDP and GVA, the growth rate of the financial services sector is much better. And same thing, when it is falling, of course, it is falling more also. So it's magic in the sense that it's interesting observation, because see, when the economy grows, the growth of the financial services sector is more. So there could be a causal effect, or both ways also. It could be both ways also. One is that because financial services sector is growing, like in the earlier days, when we did not have the developed stock market like today, it was look at the earlier days. So it was all mainly bank financed. So, but we can say that, look, because banks lend more, companies could access the required finance. They invested, they did what we call as undertook capital expenditure, and accordingly that capacity was built in, and then everything happened. So that is also there. So whether it is that this cost this one, financial services sector cost this one, or whether it is that, look, economy itself galloped ahead, and because of that, look, that is like, it is like whether it was the supply side or the demand side, or whether it was, both of them worked in tandem. So this is an interesting point. But so these are the 2 points that have been made. Both of them are valid. I agree with that one. But my question is, what could be a conclusion, which will be the next slide that I'm showing, which you can make out?
Manufacturing sector, sir?
No.
Service sector and GDP.
Service sector and GDP, it is there in the next slide. See, I have shown you very well clear. Service sector and this one also, because see, service sector and GDP, see, like I will tell you one thing, what you said is correct. If you start at this point of time, the share of the service sector was much less. It has grown over a period of time. Today, what is the share of agriculture at this point of time is much higher when compared to what it is today. All those type of things I agree. So the shift has happened between the 3 sectors of the economy, and today it is largely service oriented economy. It's well taken, but that is not what you can make out from the trends from these 2 slides. Okay.
Is it other than the financial sector, that performance and financial sector?
No.
Okay.
So I will take you to the next slide. Now, can you understand something connecting to the earlier 2 slides and what we have thought about, what we have discussed with regard to those 4 papers? This is the context in which I took that much time to tell you the theory. So what is it that you are finding here?
One thing is the clear, sir, that is positive link between the 2. Okay. And then the finance sector growth is higher than risk. And the another thing is that the volatility, which is more in the financial sector, the fluctuation is more. And whenever the real sector is going upward, the financial sector is also going along with. However, whenever the finance sector is going, it's not reflecting the same trend in the real sector.
Yeah. So that is there actually, like that point is well taken, that volatility in the financial sector, if you look at the growth rate, it is much higher than compared to the growth rate of the GDP and growth rate of the GDA. Yes, very evident. But one thing what I wanted, just my point of connecting the theory with these two slides is that growth rate, if you look at it, whether it is the services sector growth rate or whether it is the overall economy growth rate as measured by the growth rate of GDA or the growth rate of the GDP, financial sector was growing at a faster pace, correct? And looking at the theory that we were talking about, that as an economy marches ahead, as economic development happens in a country, the share of the financial sector goes up. And one more thing we read about there was that, look, there are two viewpoints. The first was the first two papers, which said that, look, securities market will overtake banking sector as economic development happens, more economic development happens over a period of time. And the third paper said, no, from the Asia Pacific point of view, as regards developing economies are concerned, it's the overall financial development that matters rather than looking at a particular sector within the financial market. So we are not bothered about, whether it is banks, bonds, equities, we want overall financial development. So now that point, see, that particular, supremacy of securities market as economy grows, that you keep aside. But one thing what was made out in the papers was that as economic development happens, financial development also happens at a faster pace. And that is the reason why, if you look at these two slides where, clearly, it's not like, this is like almost GDA, GDP is almost one overlapping the other. But the growth rate here, when it is positive shock, this financial services subsector is growing at a higher rate, and when it is negative, of course, it is at a lower rate than the overall economy or GDA, but those instances are less over the entire period that we are talking about, more than 72 years. So because of that, that is the point that, if you look at it, underscoring what the theory has told us, from a level of, so here you have the base year, not base year, the first year also. Here 1950-51 also comes. If you look at it, at the level of the economy, the overall Indian economy I'm talking, from less than 1%, from 0.93% of the GDP, and it is, there is no question of that volatility is missing here, because when GDP has fluctuated, financial services sector also has fluctuated. But keeping aside the growth rate, the aggregate level of output, the aggregate level of GDP, and the size of the financial services subsector, if you are taking the size of the financial services sector in the GDP and the size of the financial services sector in the GDP as the numerator, and the size of the GDP as the GVA as the denominator, total GVA of the economy as the denominator, you can find that from less than 1%, it is on a constant basis, it is on a growth path. And because of that, that share today, as per the 2020-21 data, it stands at an all-time high of 6.55%. If you allow me to say, it has almost grown by 7-fold, because here it was less than 1%, and here it is almost 6.55, is as good as 7. So that is what from 1950-51 to 2020-21. I could have taken the latest data, but then this much of breakup, and trust me, this is there, except that I have put it in the form of a chart. That raw data is available to you all from the MOSPI website. And within the service sector also, if you see, so now services sector is only a subsector within the economy, overall GVA. That is why from a level of 3.38 during 1950-51, today it is 12.23. So here also almost 3 times it has grown, and its all-time high was during 2007-8. So that was, the peak was during the time of the financial crisis, and that was 12.86. But today it's comparable, 12.23. So even within the service sector, its share has almost from 3.38 to 12.23 is as good as 4 times, 4-fold growth has been there. So I will stop here, and we can reassemble after a break of 15 minutes. So we will reassemble at 3:50. Is it fine?
Yes.
Yes, sir.
Yes, sir. Yes, sir. Thank you.
Okay. Yeah.
Thank you, sir.
Thank you.
Excuse me, sir.
Yeah.
Shall we start the section, sir?
Yeah.
Yes, sir.
If everybody has come back, we can start.
Yes, sir. They are, sir.
Okay. So I hope whatever the theory, and based on that theory, what is it that the Indian data is showing? Of course, I will come to the relative share of banks and financial securities market in the subsequent slides. But that aside, that financial development and economic development, what is the Indian experience, and compared to what was the theory we have already looked into. Now let's come to the securities market, because the topic is role of financial markets in the US $5 trillion economy. Now, I mentioned also, so there are several subsectors are there. Banking sector, then we have the securities market, insurance sector, pension sector. So now, if you look at some of the publications that you can have access to, for instance, McKinsey, they have one annual publication. Earlier they used to bring it. It used to bring out the index or financial development index, which is basically the sum of all these sectors put together. What will be the size of the financial sector in that particular case? So US, UK, so several economies. So they used to have that type of development indicators. So there, one thing is that in the case of India, of course, compared to other peers like emerging and developing economic peers, we had data availability was much better. But still then, those studies, looking at the period that they covered, that much of data was not available for emerging and developing economies. Another thing was that compared to the size of the financial markets in the developed economies, the size in the emerging markets were less. Of course, that is because our GDP itself is less. That is why when you look at the size of the global economy, like, we are talking about from 3 trillion to 5 trillion. Of course, we had given a roadmap or, likely date where we will be achieving that goal. But because of COVID, we had to reschedule, and then we were hit with the Ukraine war and whatever aftermath of that war in Europe. So now that also has come in the way of our achieving this particular goal. But then thing is, so that is what actually, when you look at the size of the other economies, definitely we know that size is less. Our share in the global GDP is less. And so now within that, now you know that financial sector, several sectors are all smaller only. So that is one of the factors. But what I wanted to tell you at this point of time is, so that is why in my subsequent presentation, I will be showing within Indian economy how the growth has been for the securities market. And then I will connect it with what I told you with regard to 4 papers that we had discussed in the first part of our session today. Now, you are all aware, I mean, of course, it was said also that, look, I mean, I have working in SEBI. Now, if that is the one, now, what is it that you people, I mean, one of the question was earlier raised also about participation of small investors in the securities market. But before we get to that one, I mean, the participation rates and investor population and all. So what is the role that SEBI is playing? And is it that, you know, I mean, what is your estimate of when was this SEBI established, or when was RBI established and all? Any idea?
RBI in 1935, sir. Nationalized in 1949, I think.
And SEBI?
SEBI 1983, sir.
Okay. Anybody else on? So you are closer.
1992, sir.
So actually, so see, 1983 is not the one. 1988, SEBI was set up as an administrative body within the Ministry of Finance. But 1992, it was established as a statutory autonomous regulator by an act of Parliament, the Securities and Exchange Board of India Act of 1992. So first answer was closer, that, you know, 1988, the body was set up as a administrative body, like, you know, you call within a department of the Ministry of Finance. But when I say statutory autonomous, what are those 2 words standing for? What is statutory?
It is an independent organization.
That is autonomous.
Autonomous. Statutory, that is governed by law.
By law. So that is what actually. So the SEBI Act of 1992, which was passed by the Parliament of India. So that is what actually is emphasized by statutory, and that gave birth to SEBI as a statutory body. Autonomous is what you mentioned, that we have financial autonomy and operational autonomy. Financial autonomy means that SEBI or the regulators, other regulators, so, and it is the case in other jurisdictions, other countries also. We are not dependent upon the government of India for meeting our expenses. So we have our own sources of income. We have, you know, we grant registration. So for granting registration, we have registration fees, renewal of registration. Earlier it was there. So that also had levy. We have levy on the turnover in the stock exchange. So those amounts come to us, and our revenue and capital expenditure is net out of those revenues. We are not dependent upon any transfers from the government of India from its budget. So that is what autonomy as regards financial autonomy is concerned. Operational autonomy means that except on a question of policy where the Ministry of Finance has to inform SEBI in writing, all other matters, SEBI as a regulator is independent and free to take its own decision. Only on policy, and when it comes in writing from the ministry only, we have to go with the direction from, I mean, with that correspondence. So that is, you know, that is the reason why SEBI was set up separately from the ministry by enacting a law also when acting an act. So that is what actually it's meaning about. So now, why I asked you this question is, so when we are looking at, 75 years, and when I showed you the data also, yes, there was a period up to 1992. And what was that body which was existing prior to SEBI? SEBI did not come into a vacuum. What was that body? I will give the abbreviation. If you can attempt, I think I will be happy. CCI. CCI was the body which was earlier existing prior to 1992. That was controller of capital issues. Now, why I mentioned to you is that controller of capital issue, so that was a control, license, permit, quota, Raj, before the 1991 economic reforms. So here also, the issue size, the price of the issue means price at which the companies can come and sell their securities in the market. So that also was determined by CCI. Today, that is what I mentioned in the context of ESG also, that, the difference that, I asked you a question also, compared to a bank deposit and compared to the investment in equity, what is it that I told? Disclosure. So it is a global practice that you disclose everything, and if everything is disclosed in a true and fair manner, investors, based on that informed decision, or in economics terms, the market forces of demand and supply will determine the price. So this is what the underlying logic. Now, in developed jurisdictions, this has, a fancy term is there. They call that sunlight is the best disinfectant. So, I mean, it has so many curing properties, sunlight. If you go out and during daytime, so your body will accumulate vitamin D. But what I'm saying is, in the case of disclosure, is that you are throwing everything open. And if everything is, disclosed in a true and fair manner, I mean, that has to be true and fair. Full disclosure also should be there. Then analysts can do their analysis, and they can even bring out research reports, investment advice. Accordingly, everybody will be well informed. So that is the context in which, so in addition to being statutory and autonomous, it was disclosure-based regime. And one more thing which has happened around that time was that earlier, when you were thinking about a stock exchange, I mean, people who are little, everybody, since you are all having experience, you might have at least experienced that also. Otherwise, you must have read about it. That earlier stock exchange used to be a trading ring within the premises of the stock exchange. Today, every nook and corner of the country, you have a trading screen is there. It's because it is screen-based autonomous trading platform of the stock exchanges that is installed at every place. It's not just restricted to, say, it's not the Madras Stock Exchange where you have to go to that particular place, or you have to route your broker to a broker who will go to that place, and all other, stock exchanges also. So now let's look into the role of SEBI. I mean, here I will just, go a little faster because this may be known to you. Suppose, you want me to explain more, I will take the time. Otherwise, this will give actually a few slides only, before I just jump into the securities market and its role today, and what is it that the role that it will be playing in the years ahead when we are marching towards that $5 trillion economic goal. So what it covers is like SEBI Act, somebody mentioned. So it has a preamble. That preamble clearly says that SEBI is a board, or SEBI has been established as a board to protect the interest of investors in securities and to promote the development of the securities market and to regulate the securities market. So this is the mandate that has been given to SEBI by the Parliament of India. So there are three mandates: protection of investors, development of the market, because of course, it's not like as developed in the case of developed markets like US or UK. So there is a market development priority also is there for the regulator, and then regulating the securities market so that safeguards are there in place. Now, how we establish this is there in the functions of SEBI. So regulating the business of stock exchanges and any other securities markets. So stock exchanges are there, so they are registered and they are regulated, and on-site and off-site inspections are also there. Then registering and regulating the working of stockbrokers, sub-brokers, share transfer agents, bankers to an issue, trustees of trust deeds, registrars to an issue, merchant bankers, underwriters, portfolio managers, investment advisors, and such other intermediaries as may be associated with securities market in any manner. Registering and regulating the working of depositories, participants, that is depository participants, custodians of securities, foreign institutional investors, credit rating agencies, and such other intermediaries. Registering and regulating the working of venture capital funds and collective investment schemes, including mutual funds. Promoting and regulating self-regulatory organizations. Prohibiting fraudulent and unfair trade practices relating to securities markets. Promoting investors' education and training of intermediaries of securities markets, prohibiting insider trading in securities, regulating substantial acquisition of shares and takeover of companies, calling for information from, undertaking inspection, conducting inquiries and audits of stock exchanges, mutual funds, other persons associated with the securities market, intermediaries, and self-regulatory organizations in the securities market, calling for information and records from any person, including any bank or any other authority or board or corporation established or constituted by or under any central act or state act, which in the opinion of SEBI shall be relevant to any investigation or inquiry by the SEBI in respect of any transactions in securities. Calling for information from or furnishing information to other authorities, whether in India or outside India, having functions similar to those of SEBI in the matters relating to the prevention or detection of violations in respect of securities laws, subject to the provisions of other laws for the time being in force in this regard, performing such functions and exercising such powers under the provisions of the Securities Contracts Regulation Act 1956, as may be delegated to it by the central government, levying fees or other charges for carrying out the purposes of this section, conducting research for the above purposes, calling from or furnishing to any such agencies as may be specified by SEBI such information as may be considered necessary by it for the efficient discharge of its functions, performing such other functions as may be prescribed. Now, I will stop here and ask you if you have any doubts on this. These three, because I ran it through, because this gave a background of what is the role of SEBI.
So why financial literacy is very low in India? Less than 10% of the population is directly involved in stock market trade.
Yeah. So this is what actually was earlier also raised. I told we will come to that one. So now financial literacy is low, but it is improving. I admit, I mean, it's low, and see, that is why, earlier also one person mentioned that, look, I mean, people prefer to invest in land and gold. So because financial literacy is low, Indian households, you people are using the data every year it comes out also, that saving investment data from the Ministry of Statistics and Program Implementation. So households, which are the largest savers in the economy, their deployment of saving to physical assets are more than their deployment of saving to financial assets. Second, even within financial assets, which are the ones which are getting larger inflows from the households? That's what you are telling. But so if less number of people are investing, earlier madam also had suggested that one. Why is it that middle class not that investing? So my question is, where are they investing? So where is it that the financial savings of the households, where is it invested predominantly?
In gold, sir.
No, that's not financial saving, that is physical asset.
Deposit, commercial bank
Bank
deposit.
deposits, insurance policies, public product.
Mutual funds.
No, mutual fund and equity shares. That is what actually Professor has just now told. It's very less.
A mutual fund investment is around 30%, but direct financial investment is less than 10%.
Where are you saying 30%? Which is the data source that you are telling?
I read in some articles.
No, you are wrong. Allow me, let me complete this one. Please just remind me. I will take you to the RBI website or MOSPI website, and I will show you that data. I'm telling you, if you are saying that 30% of the financial savings of the household is coming to mutual funds, and you are saying that, am I right? And 10% in direct investment right now.
Yes, sir.
Correct.
Yes,
So
sir.
you say 10% plus 30% is 40% of the financial saving is coming to securities market. See, we are as developed as US. See, I will show you the real numbers rather than guess estimate at this point of time, because they're very low. I will show you that one. I will show you that one. So, and second thing I wanted to tell you that which reminded me of another data set, because you see the flow of funds, stock and flow of funds of the Indian economy. Now that is also coming on regular basis. So there you have flows during the year and the stock of the assets at a particular point of time. So what happens is that you have the cumulative investment of all these years, which will be the stock at the end of that particular year. So that data also, RBI is bringing out regularly articles also, analysis also, and full data sets are also made available. You maybe have already accessed that one in the database on the Indian economy portion of the RBI website. But I will take you to that. Please just remind me at the end of the presentation. But I'm telling you those things. So I will just move ahead with that particular statement that it is the banks, the bank deposits, insurance, provident funds, insurance policies. So they are the major financial assets in which households are investing. Now, yeah, so as regards these roles that I have told, 3 pages, three slides, anything we need to discuss more? I think, see, it is all clear because, see, that's why, see, there are so many intermediaries and market participants that SEBI registers and regulates. That is one thing. And then developmental role also is there, regulatory role. So that is the sum and substance of it. And when you say that, investor protection, like financial education, it was mentioned, financial literacy, it was mentioned. So what motto that SEBI has towards the financial education. So of course, what we are having is that a well-empowered investor, well-educated investor is a well-empowered investor. So this is the motto for our investor education workshops. So this is what it is.
Sir, this is Adarsh Gupta from Gaya College, Bihar. Sir, my question is, despite having a very active role played by SEBI in regulating the stock exchanges across the country, we have seen in a very recent time, there was some sort of, you can say, fraud against the former MD of NSE. So why this kind of negative things happens despite having a very active watchdog kind of role of SEBI? Would you put some light on this issue, sir?
Me, as I told you, like this is, I was just looking at from, question from this particular point that we are discussing, but I will tell you, slightly touch upon the other thing. So now you see that, proper action has been taken. That's what you are reading out all these days also.
My second question is, in comparison to Bombay Stock Exchange and NSE, which one is the larger one, sir? This is my question.
I will give data sets to support my answer. If you look at the equity cash segment means you are buying the shares only, not the derivatives. If you are looking at the equity cash segment, NSE accounts for 93% of the total turnover. BSE accounts for only 7%. And there is no other exchange where trading happens in the equity cash segment. So like, you are trading, say, for instance, on LIC shares. You are not trading, as of now, derivatives are not there on LIC shares, but just buying and selling LIC, it happens only between these two exchanges. So that's what I'm telling you. So if you look at equity cash segment, 93% of the activity is on the NSE, BSE may only 7%. And as regards equity derivatives, it's almost 100% by NSE. BSE.
Is it right if I compare the market capitalization of the 20 listed largest companies of BSE and the 50 registered company of NSE, then can we compare the size of which the stock exchange is greater? Am I right if I compare by this method?
No, you are saying 20 company or 30 company? NSE, you are saying BSE.
BSE is about 20 companies, or 30. 30. I'm not 100% sure. So
see, that actually I understood what you are saying. See, like I will tell you, I will answer you this question also. But see, let's look into this one because we have a question answer session at the end of the presentation, and we need to finish this. So, but I will answer your question. What you are asking, I understood. See, Sensex is a index constituting 30 largest and most liquid strips of BSE. Nifty 50 is an index consisting of the largest and the most liquid 50 strips of companies of NSE. So, for your information, why you're asking this question, I understood. See, there are between this 30 and 50, many are common. Only that 50 will have extra 20 or, so to tell you this one, that is the reason why, the broader movement will be same, but the one which has larger number of shares, it will be affected by extra 20. If it was not that, if it was both were 50, then it would have been almost standard. Like I showed.
I got it.
So let's, on these 3 slides, if there is no other question, we will move to the next one because we will, I will have definitely, topics other than what we are covering here also. If you want to take up with me, you are free to do that one at the end of the session. Okay, so now when I say, SEBI has, these are the, these functions which it has to discharge, definitely you need to have certain powers also. Only then you can discharge those functions. So some of the powers which are enlisted in the SEBI Act, I have listed out here. Power to undertake inspection of any book or register or other document or record of any listed public company or a public company which intends to get its securities listed on any recognized stock exchange where the board has reasonable grounds to believe that such company has been indulging in insider trading or fraudulent and unfair trade practices relating to securities market. Power to regulate or prohibit issue of prospectus, offer, document, or advertisement soliciting money for issue of securities. Power to issue directions and levy penalty. Power to investigate. Power to search and seize. Power to order cease and desist. Power to disgorge. Power to levy penalty. So these are all the powers that are exercisable by SEBI, and these are all, very wide and vast powers. And going by this, SEBI's powers are comparable to any other regulator in any other market, any other economy, or any other jurisdiction. Now, just wanted to highlight 2-3 things, like, power. Let's go to the second point: power to regulate or prohibit issue of prospectus of a document. So I told you about LIC case. So LIC or any company, before it issues shares to the public, it will file its draft offer document to SEBI. So that draft offer document will contain details about the company, like when it was set up, what was the name, how it has been doing business, what are its financials, who all are there in the management of the company. All those things will be there, and including details as to why it is raising the finances now, like what is the project that it is going to finance. So all those things will be there in the offer document, and the due diligence of that offer document will be done by merchant bankers. So company is stating something, but the veracity of that one, the due diligence of that one will be done by the merchant bankers, and that offer document will contain even the due diligence certificate issued by the merchant banker also, and it will be filed with SEBI. And as I told you in the beginning itself, transparency and disclosure, going by that one, as soon as it is filed with the SEBI, it is made available to the public, the whole world, by hosting it in the website of SEBI. So that is what the thing is. And then if there are no adverse observations, like, so SEBI will also vet that offer document. And only when it is like, no adverse observations are there, when the company clarifies the questions or provides additional information what SEBI is asking for, then only will that issuer, the company, will be able to issue its shares. And then after issue of shares, those shares are listed on the stock exchange. So till that listing, what we call is the primary market. Primary because that is the first time that somebody is buying the share of the company, and that is from the company. But after listing, it becomes the secondary market. That is where, people who may have got allotment of those shares in the IPO, and they want to sell, maybe they want to book a profit, or they want to stop loss, or they want to meet some expenses, so they are selling it. So then an existing investor is selling those shares to somebody else who is willing to buy that one. So that is what it is known as the secondary securities market. So that is one thing. Then, like I just mentioned about power to disgorge. So disgorge is the ill-gotten gains. Now I would like to mention something, because one question has been raised about financial literacy. So see, so those ill-gotten gains which SEBI disgorges from an entity, that goes to an investor protection and education fund. So those funds will be used only for undertaking on a pan-India basis investor education workshops. And also, say, for instance, suppose some investor protection initiatives also need to be financed, that also there. So there is a set of objectives for which that fund can be utilized. So that is what I am trying to tell you. When I said we are a financially autonomous institution, it's not that, disgorged ill-gotten gains, they are not part of our source of revenue. That goes to investor protection and education fund. Similarly, when penalty is imposed, is it that SEBI is getting it? Can we treat it as our revenue? No. That goes to the Consolidated Fund of India. Why is that check and balance put in place? Is because SEBI cannot be, hungry of imposing penalty and then that process adds to our revenue. No. If there are violations which are being observed and which have been adjudicated by an adjudicating authority in SEBI, then that penalty so imposed will go to the Consolidated Fund of India. It will not be part of the revenue of SEBI. So now what I wanted to summarize on this particular slide is, over a period of time from 1992, SEBI Act has been amended to give us more powers, and the powers as they stand today are comparable to the power that any other securities market regulator will enjoy. For instance, in the US, the securities market regulator is known as the Securities and Exchange Commission, comparable to that one. So then Financial Conduct Authority, that is the agency in UK. Then ESMA, European Securities and Market Authority, that is the European Union-wide authority. So this is what it is. And now let's go to the next slide. Now, this gives a flavor of the size of the Indian securities market as on 31st March 2022, which is the latest financial year data that we have. So we have 7 stock exchanges are there. Number of listed companies in India are 5,350. No other country has this many number of listed companies. So India is home to the largest number of listed companies in the world. And I started in the beginning by asking a question about the size of the stock market in terms of stock market capitalization. So I told that, yes, now the stock market capitalization is higher than the level of GDP. And I am giving you the figure in this slide, which is $3.5 trillion US. So it is higher than the level of GDP. That I will show you in the in one chart itself. I will show you. But in absolute terms, we are $3.5 trillion US. Many of you might have been investing in the securities market through mutual funds. So there are 47 mutual funds in the country, and the schemes that these mutual funds have brought in, they number 1,495. As good as 1,500 schemes of the mutual funds are available as on 31st of March 2022. And portfolio management services, which are for high net worth individuals, people who can invest smaller amounts can go towards mutual funds, but who have larger amounts. So that is known as portfolio management services. So there are 367 portfolio management services are there. We discussed about the importance of foreign portfolio investors. So there are 10,608 foreign portfolio investors. Then all of you are reading about, especially in the COVID times, how we could escape a severe dent on our GDP was because there was a lot of construction activity. There was a lot of investment in infrastructure. So to promote the investment in infrastructure, a special purpose vehicle by the name of Infrastructure Investment Trust have been permitted. Similarly, to promote investment in real estate, commercial as well as residential. So we have a real estate investment trust that is also a special purpose vehicle. So as on 31st March 2022, 17 infrastructure investment trusts are there and 4 real estate investment trusts are there. And I mentioned to you also, like now you have to approach a broker to transact in the securities. So across all segments, means equity cash segment, equity derivative segment, interest rate segment, currency derivative segment, commodity derivatives. These are the segments that a stock exchange has, which comes under the regulatory ambit of SEBI. And across all these segments, more than 17,000 brokers are there. And I mentioned in the beginning when we are looking at the functions of SEBI that, depositories are there. What are depositories? What is the role that they are playing? Because if you have invested in equity shares, definitely you have come across a broker and you have come across a depository participant, depository also. From 1996, this Depositories Act has been enacted. So from there, we have depositories which are having dematerialized or electronic share certificate. So we don't have now, that share certificate and endorsement of the share certificate if somebody is selling. So those were all prior to the depository period. Over a period of time, over almost 25 years have gone by. NSDL has just now only celebrated the silver jubilee. So we have almost moved to zero physical share certificate. Everybody is owning it in the mode of demat. So that is what, and the two depositories, one I mentioned, National Securities Depository Limited, NSDL. The other one is the Central Securities Depository, CDSL. Yeah. Then custodians, 19 custodians are there. So custodians of securities. Then foreign venture capital investors and alternate investment funds. So there are 279 foreign venture capital investors are there, and 885 alternate investment funds are there, and all other intermediaries. Because when you have seen that functions of SEBI, other than these named entities, there were other intermediaries, market participants, all put together. There are about more than 7,900. So this is a bird's eye view of Indian securities market as on 31st of March 2022. And now if we go to the next slide. So now where are we standing vis-a-vis other global markets? Now let me tell you this particular one. This is as on 2020 end, of course, because I could not update that one, but it will be almost the same only. I mean, maybe one up or one down could be, or the same also. But I'm just warning you, this data is as of end 2020. Rest all are of 2021. So now, why I'm saying is there has been a growth of the securities market. So we are looking at a cross-sectional analysis, other countries at the same point of time. Time series we will come later. So in this cross-sectional analysis, now we are looking at number of trades. We are not looking at the value, because value-wise we will be much less, because say for instance, if you look at the dollar, it's almost 80. If you look at pound sterling, it's almost 100 per pound sterling, and same 85, 86 as regards euro is concerned. So number of trades means, see, like I will tell you, you have done one buy and one sell during the day, irrespective of the number of shares you bought, irrespective of the price at which you bought, and similarly irrespective of the shares you sold or the price at which you sold. What will be taken into account is you have done 2 trades during the day. So that is what the number of trades. So if you look at that way, at end 2020, National Stock Exchange of India, I mean, I mentioned earlier also that 93% of the trades happen on NSE. NSE is ranking 4th globally. And this exchange rate issue is not just for India. That is why this data, when I mentioned about one of the papers that we discussed, that paper was by World Federation of Exchanges. So this global ranking is also done by World Federation of Exchanges. And WFE does it for all the exchanges on the basis of number of trades only. Value is not at all, because see, Pakistan is there. I mean, look at all economies. It's how many countries are having, dollar as their exchange, I mean, as their currency. So that is the reason why, I mean, when you have to discount for that particular factor, they have adopted number of trades. So I am not just, taking this factor only, because this is the factor that this is the indicator that they are using. And in terms of the trades that are happening on an annual basis, this was the fourth in 2020. Rest all data is for the whole financial year 2021, and that is done by World Federation of Exchanges. So that is like a global ranking by a agency, so which we can cite. 9 of the derivative product lines are offered in India compared to 13 globally. So it's that, like, if almost every product that is offered by the stock exchanges in the derivative segment, we are also offering. So that's why I told derivatives itself, we have the futures and options, we have derivatives on single stocks, we have it on index, then we have on currency derivatives, we have commodity derivatives, interest rate derivatives. So that is how all put together we have 9 derivatives products are there. Then if you look at all the global derivative exchanges in 2021, NSCL ranked first in terms of stock index options contracts traded, first in terms of currency derivatives contracts traded, fifth in terms of single stock futures contracts traded, seventh in terms of single stock options contracts traded, and ninth in terms of long-term interest rate derivatives contracts traded. So what it tells is that in terms of the number of contracts traded, so that is what actually, that is the indicator that is used to compare. It's not the value of trade. So there also on many of the products, the number of contracts traded in India across all the exchanges is very good, and NSE's rank in terms of these indicators, it is starting from 9th in the case of long-term interest rate derivatives contracts to first on 2 products, first on stock index option contracts and currency derivatives contracts. Then among the global derivative exchanges in 2021, Multi-Commodity Exchange of India ranked 7th in terms of commodity derivatives traded and first in terms of commodity index derivative contracts traded, 4th in terms of precious metals derivatives contracts traded, that is gold futures and gold options, silver and all, and 5th in terms of energy derivatives contracts traded. When I mentioned that, look, I mean, there are futures and options and derivatives are there on single stock stocks as well as on stock indexes. Among all the exchanges in 2021, 2 products from India, Bank Nifty and Nifty, which are the popular products in India, they are the most traded and the second most traded index option contracts globally. So Bank Nifty is ranking first in the world, and second also is from India only, that is the Nifty index options contracts. Then among the top 10 currency contracts traded globally in 2021, USD INR options ranked first, USD INR futures ranked third, and pound sterling INR futures ranked 7th. So this shows that, see, over a period of time, the trading activity in the country has picked up, and because of robust activity within India, India's position among the global exchanges, it has improved. Today, this is one key point that we can take note of. Then I mentioned about investment activity. So corporates, they have their net profit is there, and from the net profit they will be having retained earnings which they can use for future investment, and after retained earnings they will declare a dividend also. So that is how net profit is apportioned. So retained earnings are there, but retained earnings are not the only source of their investment, because some of the investment that they want to undertake, they may be larger in terms of amount. And similarly, some companies may have surplus, lot of retained earnings may be there, but it's not the case with regard to all the companies. So that is why they are actually the people who demand the savings of the households. And of course, government is also there. They also come and issue securities, government securities and treasury bills, and they also borrow from the market. But major one is, of course, the private sector companies. And So that is where, on the one side, we have the demand, and supply of that comes from mainly the households only. So they also will be putting their money in this one. So if you look at the last 3 years, you can find that especially the 2020-21. See, let's look at the last row. So it shows across all activities, like in equity itself, IPO, that is the initial public offer. FPO is follow-on public offer. So like, let's go back to the LIC instance. Suppose government wants to raise more money by selling the shares. So then it becomes follow-on public offer. Or suppose LIC wants to raise money from the people for growing its business. That also is follow-on public offer. Then rights issue is when it is issued to the existing shareholders and money is raised from them. QIP is when it is issued to institutions on a private placement basis. So that is the qualified institutional placements. Then preferential allotment also is a sort of private placement you issue to a select group of investors, especially institutions only, who will be, so these are all, quick modes, whereas public issue is more time consuming compared to these private placements. So if you look at that, latest year, we have 542 issues in equity securities and 2,31,030 crores of rupees was raised. Similarly, in the case of debt securities, of course, if you look at debt, there are only two categories, public placement and private placement, and look at it. Private placement is significantly high in terms of the number of issues and in terms of the amount that it raised. So latest year, we had almost close to 6 lakh crores of rupees that was raised from the market by issue of debt securities, and put together 8,30,656 crores of rupees was what was raised from the securities market. And previous year it was even more, 10,12,225, and the year before that it was 9,96,013 crores. So overall, see, this one particular thing is affected, especially because of events since February, the volatility that you people have also mentioned because of the war in Europe. You also know, initial round of talks when it was happening about LIC listing in the last financial year itself, it was for 5% of the equity share capital, but it was reduced to 3.5% subsequently because of the geopolitical tensions and the effect on the financial market, and also pricing also, what it was initially spoken about and what was the rates, what was the price at which it was finally issued. So you people can look into that. So what I wanted to tell you here is, if you look at this amount that is raised from the market by issue of debt securities, see, there is one thing that you should take note. That is, the amount raised by issue of debt securities is now greater than the incremental bank credit during the period. So whatever is the fresh bank credit extended to companies, that is lower than the amount of money that they have raised from the market by issue of debt securities. So that also shows, underlining the theory that we have spoken, that the role of the securities market will be little bit more at higher levels of development when compared to the role of the banking sector. So this is one particular data point that I would like to present before you. The second one is, like I mentioned about the size of the stock market in absolute terms in this slide, which is 3.5 lakh trillion. Now, is it that, the growth of the stock market was in tandem with the growth in the economy, or it was higher or lower. Now, I have a chart here. The bar line, the bars are the absolute level of the stock market capitalization, and other line one in the chart, that is about the share as a percentage of the GDP. That is the stock market capitalization ratio. Now, what is it that you can make out from this compared to the theory that we discussed at the beginning of our presentation? So, is the theory applicable in the Indian context? See, BSE total market capitalization in rupees crore, that is the blue bars that you are seeing, and stock market capitalization ratio, which is market capitalization, stock market capitalization as a percentage of GDP. So what about the facts on the ground compared to the theory that we have discussed at the beginning? We have data from 1989-90, every year data up to 2021-22, which is 31st of March 2022. What is it saying? Are we following the path that the theory was telling us?
Yes, sir. The size of the stock market is increasing with the increase of the size of the economy, which is basically the economic growth.
Yeah. I did not hear. Hello.
Yes, sir.
Yeah. What was it that you was mentioned? Second point.
Sir, some error, sir.
Okay,
Technical
okay.
error.
Yeah,
Sorry.
yeah.
Sorry, sir.
No issue, no issue. So if I say yes, in the absolute terms also, see, look, the bars are becoming longer. But see, this is what it is, 111. No, sorry, okay, this is, see, look at that number, 2,64,000. 2 crore 64 lakh, I beg your pardon, 2 crore 64 lakh 6,501 crores of rupees is the size of the market capitalization in rupees crores. Okay, whereas, so it is 2 crore 64 lakh 6,501 crores of rupees. Whereas if you look at the market capitalization ratio, from about 22.6% of the GDP 2002-3, that is because of that Ketan Parekh scam, the market had corrected. From that 22.6%, it is now at an all-time high of 111.6% for 2021-22. So market capitalization as on 31st March 2022 compared to the GDP of 2021-22 stood at 111.6. So we have exceeded the level of GDP. So see, but you people must have noticed, yes, there is big fluctuation. See, this is the global financial crisis time. This is the COVID. So there is fluctuation is there, but still then if you look at it, like, I mean, we are economists, if we plot a trend line, it will be upward sloping only. See, it may be, you know, going through like this. It will not be 100%, trend line will not touch 100%, it will be less than 100% only, but still then, so this is what I am telling you. So 2 points to drive home the point that the theories lessons are applicable to India are, one is that from the bond market, the money raised by the companies is much higher than the bank credit that they have availed. Second is that stock market capitalization. So that as a percentage of GDP also is growing, which shows that more companies are coming and raising, coming and listing, getting listed on the stock exchange, and they have raised the resources from the securities market by issue of equity securities. So that is one aspect. And of course, market capitalization is a function of two. Number of securities is one, and that number of securities can go up because of new companies getting listed or existing companies issuing more number of securities. Second, of course, is the price factor. So like somebody earlier, we had taken up a discussion on Nifty 50 and Sensex. Yes, so price also is one of the factors. Prices are also going up. That's why, let me clarify to you, here I am not taking the GDP at constant prices. I have taken the GDP at current prices. Like you are comparing apples to apples. So market capitalization is also at the current price. GDP is also at the current prices. So that way, inflation is, already there, added to the GDP portion also, the denominator also, and the rise in prices of the equity shares, which are getting reflected in the market capitalization also. So with that one, let's go to the next thing. Earlier, two persons have raised the issue of participation of the investors. I said something we will talk, but I clarified at that point of time two things. One is that yes, participation is less. Second, I told also that financial literacy efforts have to be more to bring in more investors. So now if you look at the position as on 31st March 2022, we discussed about dematerialization and depositories. So across both the depositories, there is 8.97 crore demat accounts. Now, this drives home the point that both of you had raised earlier. We are a country of 135 crore people, right? 135 crore.
38, sir. 138.
Okay. So how many are the demat accounts? And here double counting is there. Like, so it's not that, we have taken PAN and then seen how many are unique. It's not unique number of demat accounts across both the depositories. So I'm telling you, this is the reason why I did not answer that question at that point of time, because I knew the data is coming. So let us devote our time here for the discussion. So 8.97 across both the depositories also. So I can have one account in NSDL, I can have another account through another DP CDSL also. So both will be counted as if, even if it is I am the owner, it will be take two. So what I wanted to tell you is, yes, we are having lesser participation compared to developed economies. But the comforting factor here is that now that the equity cult has started taking roots, or all the financial literacy initiatives by everybody is starting to show some results. On an average, during 2021-22, 28.83 lakh new demat accounts are being opened. It's a very good thing. Compared to the trends that were in the past. So like every month from April 2021 to March 2022, 28.83 lakh demat accounts are being opened. Of course, that was because, there were so many IPOs coming and hitting the market. People wanted to invest. So those type of, let's keep aside those factors. Definitely what I want. Hello?
Raja sir, can you mute?
Yeah. So next indicator of the growth in the securities market is that there are 12.95 crore investor folios with domestic mutual funds. Now, somebody already mentioned, yes, many people are investing through mutual funds. Some people approach through direct investment also. So what I wanted to tell you is this 12.95 investor folios with mutual funds, many of them may be having the demat accounts in the initial one that we are seeing, 8.97. So there are, what we call, like in the case of set theory, the common area, the A intersection B, it will be large. So still then I am telling you 12.95 crore investor folios are there with the domestic mutual funds. And there, like if you look at the whole year, on an average, every month we saw 26.37 lakh new investor folios being opened with the mutual funds. But now here also I will just give the, so see, suppose I opened folios with 10 mutual funds. We had earlier seen how many mutual funds were there? 47. Suppose I opened with 47 mutual fund a fresh account during the year or during the month, it will be like 47 new folios, even though it was only me. So that is one thing, but still then I'm telling you on an average, we are seeing there also a healthy growth of 26.37 lakh new accounts being opened. Then SIPs are there. SIPs are basically, to encourage small investments by the households, but like, many a drop make an ocean, like that type of saying. Over a period of time, if you keep on investing, even if that it is a small amount, then you are riding the market, whether it is a rally or whether it is a correction. But at the end of the day, you will end up having larger amount of savings, because when the market prices are going up, you will buy for the same amount. Like, you are investing 1,000 rupees per month. If the prices are rising, you will be buying only lesser amount, which is what the demand theory says. Similarly, when the prices are falling, you will be, for the same 1,000 rupees, you will be buying more number of units. So that is what actually it says that. So even in the case of that type of systematic investment plans, there are 5.21 crore accounts across all these mutual funds, and those SIP accounts accounted for 15.2% of the asset under management or AUM. Now, of the total asset under management of the mutual funds, I will come to that AUM size of the mutual fund very shortly, but of that total asset under management of the mutual funds, 53% of the AUM is held by retail individual investors and high net worth individuals. Now, retail individual investors are investors who apply for less than 2 lakh. High net worth individuals are also individual investors, but they invest more than that 2 lakh amount. So that is a threshold that defines where you will fall in. Now, this is surprising because mutual funds abroad are mainly vehicles for households to invest in the securities market. So there the share of households is much higher in the total area. Here, of course, corporates, they undertake some transactions, and that is why, so they also have investments, but they are not in direct equity securities. They are actually in liquid funds and all, so that, what you call as treasury management happens through this. So they get a return, and that is why it is, the share of the HNIs and retail individual investors is 53%. But still then I'm telling you, they are accounting for more than 50%. See. Now, we mentioned about the FPI story. Like FDI is also, a source for financing our trade deficits. Because in the trade, balance of payments, exports of goods and imports of goods, if you see, we have to pay for the trade deficit. Of course, in services exports, we are exporting more than what we are importing. So we are earning from services exports, but that is not sufficient enough to fill in our trade deficit. So that is why we just require capital account inflows, and FDI is one source. But the beauty of FDI in India when compared to other emerging market is that overall, except a few years, we have been getting positive inflows. That is what if you look at it, this one. This is the Asian financial crisis, the first dip that you are seeing. And this is the year last year. And this is the present year. I mentioned during the earlier part of my presentation that calendar year, if you are looking, this is financial year. Financial year is from 1st April to 31st March for all the years we are seeing. But calendar year wise also, if you look at it, for 2022, right from 1st January till yesterday, it's more than $30 billion is there, which is an outflow. That is more on account of external factors that the outflows are happening at this level. And the other thing is that is also one of the factors that is actually driving down the exchange rate to the levels that we are seeing. Morning when I was going through the news channels, I again came across the news item that today also, I mean, morning it had a new low. So it is like, if I am not wrong, 79.60 was what the exchange rate to rupee was at that. I mean, to exchange rate of Indian rupee to dollar at that point of time. But still then what I wanted to tell you is what story that we can tell with regard to foreign portfolio investment is that overall, see, even when one category of FPIs are selling, there may be a countervailing force from another set of FPIs also. So we, for most part of the period, since we allowed them, it has been positive inflows only, but very rarely. And today is one such, I mean, these days are one such occasion where we are witnessing. This happened, if you are allowing me to share with you, since October 2021, month-wise, we are seeing net outflows. So now I mentioned in the beginning, I mean, a few slides before that, I will show you the AUM of the mutual funds also. If you now look at this, see, so what was the first mutual fund in the country? Which was the first mutual fund or the scheme in the country?
UTI, sir.
UTI. So US 64. And so that is why, if you look at this, the data starts from March 65, March 1965. And this data is what I have taken. This chart I have taken as such from the Association of Mutual Funds of India, but I know it is only up to March 2015. So I have charted for your purpose the latest data also, which will cover the period up to the latest. So you can see this, that as on 31st of March 2022, 37,56,683 crores of rupees. And look at it. I mean, the recent years, it's a, it's like, it's not that it is a growth, it's a sharp growth that we are witnessing. And that is what I'm telling you, even though we are still at a low base, the pace of growth is something that is a comfort, a source of comfort, and that is actually bringing in more investments and also new investors also, new investors as well as more investment by even the existing investors also. So that is one factor that I would like to bring before you. Say, for instance, you look at this one. At end March 2010, the AUM of the mutual funds was only 6,13,979 crore. So now, 12 years later, it is 37,56,683 crores. So it's like from 6 lakhs to 37 lakhs. It has grown by more than 6 times over a period of 12 years. So that is it. Now, drawing upon the theory that we have discussed and also the experience that we have had and the status that we are seeing as on 31st to March. So in our journey towards a $5 trillion economy, how is it that I foresee the role of stock markets in India's economic development? This is my, looking ahead sort of slide where I am summarizing, but it is basically, I am drawing these conclusions on the argument that I have presented before you earlier. So I am telling you that more market-oriented sources of finance for companies than bank finance. We have already seen the theory as well as the data I have shown you from the Indian experience also. More of debt and hybrids than equity. So what I am saying is it will be more securities market than bank, but within securities market also, see the equity story, everybody is now aware of and they have understood that one. But the greater role or larger growth will come from debt securities and from hybrids, which are basically having the characteristics of equity securities and debt securities. Then greater deployment of household savings in the securities market. It is just building on to what you have raised correctly. Yes, participation is less, but we have also seen some indications that now the deployment of the financial savings by the households in the securities market is growing. And I am foreseeing that that growth will only increase over these years. For instance, I mean, like I mentioned also, people are putting more of their money, financial savings in bank deposits. But now the rate of interest offered on bank deposits is falling. And here, if the returns are better, definitely there will be a tendency to put their money, shift that money from bank deposits, a portion of their money from the bank deposits to securities market. Then increasing institutional participation. I told also, like, we have seen FPIs, we have seen mutual funds. So like institutional participation, it will mature over the years. And last, but the most important of it is that, look, Indian economy also has to move towards, it cannot be, growth at any cost. No, it has to be a sustainable and inclusive growth. So we have to pay equal importance to concerns with regard to environment, society, and governance, ESG. And also it has to be, like everybody stands to gain from the growth experience. So it has to be inclusive. So these are, what I consider as the defining themes for our journey towards a $5 trillion economy. And thank you for this opportunity to interact with you. It has been a very good experience, talking with you, sharing your thoughts with me. I also just telling you all these things. I hope, like there has been a consistency in what I shared with you. Now I can devote my time for questions from your side.
Sir, good evening.
Yeah, good evening.
Sir, during your presentation itself, many of us, we interacted, we raised our doubts also. If you permit, one of the participant will propose vote of thanks.
Yeah. I will, so, let me, if you can just give me one time, because 1 minute you give me, because, during the course of, so can I close this presentation?
Yes, sir. Yes, sir.
Yes, sir.
Sir, if anyone have any questions, you can raise it up, or else we can wait.
No, I will tell you, see, what I was thinking is that, during one doubt somebody had raised was that, that the share of the financial savings of the households going to securities market, 30% and 10%, they are a multiple of what is there in actual. So if you can allow me, I will just show you that, because numbers will just give me 1 minute. Just meanwhile, you can think of a question. I will just get back to you with the number.
Good evening, one and all. On behalf of UGC and HRDC,
Ma'am,
21st.
ma'am,
Yes,
can you
yes, what happened, sir?
wait a while, sir? We'll give
No.
some data, then after.
After that only.
Yes,
No,
yes,
sir.
yes.
So no, actually the department is messaging me. That's why I'm started.
No, sir said he wanted to give one data. After that, you
No
can.
problem, sir. No problem at all. I'll start later.
Yeah.
We appreciate your interest.
I'm there. Actually, the link that RBI gave for that gross savings. Yeah, I'm there. Okay, this is. Yeah, just one link I am sending, but this is the gross savings only. Just I am messaging to you. But that other portion, which is the instrument-wise deployment, I will just let me this.
Sir, one more
Yeah,
suggestion.
no.
Sir.
In the chat window, I am this is the Mosby data. This contains saving and investment, but this is the gross. Then deployment of gross financial savings. I will actually, if it is it's already, so this has one, but within the financial savings, what are the, how much goes to bank deposit, how much goes to provident fund, how much goes to insurance. So all those things, equity market, you have actually the savings in mutual fund units and savings in direct equity also is there. So that I will mail you. You can, I think there must be some group now. You will get that particular thing also.
Thank you.
Yeah.
Ma'am, over to you, ma'am. Komati, ma'am. Formally, ma'am will just propose vote at time.
Yeah.
Ma'am, your mic is
Madam,
muted.
unmute your mic,
Unmute,
madam.
ma'am.
Okay. First of all, very sorry, sir. Good evening, one and all. On behalf of UGC and HRDC 21st batch refresher course, Department of Economics. First of all, I hearty thank to UGC HRD respected Director, Professor VP Madheshwaran, sir. And I extend my heartful thanks to our respectable and lovable course coordinator, Professor Chinnamai ma'am, Professor and Head, Department of Economics, University of Madras. I take immense pleasure to thank the respected Sir Venkatachalam Ramakrishnan, who had highlighted in the field of literature review. Under that is given 4 papers like Demicucune, Popo, and Estrada and WPE. financial sector, service sector, SEBI, powers of SEBI and role of SEBI, Indian security market today, the Indian security market a way forward, and the role of capital market to achieve 5 trillion. You given very positive, and really, sir, today we have opportunity to hear your wonderful lecture. This will surely encourage us in all our future endeavors. And I truly thank the refresher course organizing committee. And last but not least, I extend my heartful thanks to all the professors from different colleges and universities participated in this refresher course this session and make a great success. Once again, I thank you all. Thank you very much.
Thank you very much.
Thank you.
Thank you, sir. Thank you, sir.
Vanakkam.
Thank you, sir.
Thank you.
Thank you.
Thank you, sir.
Thank you, sir.